Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. Joining me today is Ahmet Yetis, Senior Managing Director at Evercore. Ahmet, it's really great to see you again. Thank you for your time, and looking forward to today's episode.
Likewise. Thank you, Todd.
So, I'd like to kick off with kind of a broader trend. We've seen, private markets kind of take off the last 15, 20, 25 years. And I think Phil Totolo described it to me as kind of 65 private today, 35 public, when, you would flip that number a generation ago. Kind of what are some of the drivers behind this? Do you see this shift continuing? Like, are we going to get to 90-10, or are we kind of settling in kind of where we're at today? What is some of the, the things that are happening in the market that have grown the private markets to where they are today?
That's a good question, honestly, and that is something that I am not paying as much attention to it. As you know, I am very focused in certain parts of the private markets, but the growth of the private markets is definitely visible and obvious. Now, if you ask me if that growth is going to continue, I believe it will. But at some point, it's going to have to plateau, and we will get to a. I know I'm not telling you things you already don't know, but I expect some growth to happen, but I don't think it'll grow as fast as it has in the last 10, 15 years, I would say. If I have to bet, I think we are getting close to the stability between private and public markets.
No, it is one of the benefits of the private arena that you can get more creative with structures. You can kind of not manipulate things, but in the public markets there seems to be a standard, and there's kind of boxes you need to check. Does the private market give you a lot more flexibility?
Yeah, that's true. That's true. Less regulated, definitely. I think that has an effect on it. More open to institutional investors. But obviously, I'm sure you follow that too. There's talk around democratization of the private markets, which then started making some of the GPs accessing the retail market and what have you. I think these are just natural evolutions of financial products.
Obviously, we've come to know one another because of our fund finance conference the last couple of years, and clearly that space has exploded the last few years. I'm curious, how much of the growth can be kind of brought back to the challenging environment for LPs getting distributions. The fundraising environment for GPs has become a little more challenging. Like, are some of those motivations playing into some of these products that we see on the fund finance market? Does that play into it? Is it just the growth of private market and the growth of private funds? Like, kind of what are some of the motivations that have helped fund finance maybe jump to the level it's jumped to today?
I think it's both. I think it's both. At the end of the day, the structures and products that we deal with are fairly complicated and what have you. And the issuers, potential issuers, just need a strong incentive to pursue these complicated structures and offerings. And I think the difficulty in fundraising and liquidity environment is just giving the potential issuers those types of incentives to actually do the work, understand the market and product, and become a little bit more open to exploring these alternative ways to fundraise or generate liquidity.
So you lead, Evercore's private capital advisory group, leading structured capital solutions and debt capital markets efforts. Kind of ultimately, what does that mean? And if I were to
Yeah.
ask, what does Evercore look like today as a firm?
Yeah, no, that's a good question. So Evercore, obviously, a lot of people know about Evercore, but we are known for our M&A business, in M&A advisory business, right? That's how the bank started. But then we are also very strong in the private markets. We have a couple of verticals in there. PCA, Private Capital Advisory Groups, that is the secondary side of our private markets practice. And in there, the broader team is about 160 people globally. And we have three verticals: the GP-led secondaries vertical, where we set up continuation vehicles as liquidity solution for the GPs, as you know. The second vertical is the LP-led secondaries business, which is where we sell LP portfolios in the secondaries market. Both markets obviously are related. And the third business is what I lead, the structured capital solutions, which is what we started about 3 years ago when I left UBS to join Evercore. So those are the three legs of the stool. And the reason why I joined, there are a couple of reasons why I joined Evercore. Right. So what I do is viewed as fundamentally important for the broader PCA business. We are basically one-stop shop when it comes to liquidity needs for the private market participants, right? And selfishly, from my perspective, one of the key benefits of doing what I do within Evercore PCA is the access to the private markets. There's no large GP that we don't talk to. There's no large institutional LP that we don't speak to. The team, as I mentioned, is 160 people strong globally. Like the entire floor is like the know-how we have on this floor around the products, the strategies, and the managers and the investors is second to none. Which is one of the reasons why my team has grown quite a bit from 3 to now about a dozen, and pretty soon we are going to hit, I think, 16 or 17 people. And led to our success, basically, if that makes sense.
So you referenced kind of a couple of things there related to liquidity. Um, LPs are clearly still finding their way around certain products like NAV facilities, maybe to a lesser extent sublines. Have you seen the LP, kind of education gap start to close the last couple of years? I mean, I had someone from ILPA on, I think it was probably a month or two ago now, who had talked a little bit about, the LP perspective of NAV facilities, which still wasn't great. And the kind of the education gap that still exists. The LPs that you're talking to, are you starting to see that kind of
Yeah.
shrink as they get more used to working within this market?
Yeah, it's definitely getting better, right? And we started seeing more of that, especially after we did a couple of our LPs transactions. We talk to LPs all the time, as you can imagine. And most of them now have heard about our CFO capabilities and they've seen some of our CFO transactions. So when an LP thinks about liquidity, and when they come to us, we usually attend those meetings together with our LP team, and we put their options in front of them. They can sell in the secondary market, which is what the LP team does. We can do a CFO in the capital markets, which is obviously what we do. But sometimes the CFO product can be perceived as too complicated, especially if this liquidity need that the LP is trying to solve for is more like a one-time need and may not
Mm-hmm.
be repeated on a go-forward basis. CFO could be an overkill. Then we talk about NAV financing or preferred financing. So those are the big 3 or 4 big options we put in front of the LPs, and we walk them through the pros and cons of each option. Obviously, secondary market pricing is key criteria. Cost of liquidity in our world is a key criteria. How much liquidity they can generate through CFOs versus NAV loan, NAV market is another important criteria. We spend a good amount of time with our LP clients early on to help them kind of make a decision in terms of what they're going to pursue. And sometimes they decide to work with me. We do a CFO. Sometimes they decide to work with my colleagues in the LP team. And both, that's what I meant when I said we are more of a one-stop shop when it comes to liquidity needs.
Does the type of LP change the answer to that question? Insurance company, pension fund, sovereign wealth fund, like do the different types of LPs out there, do you see that they have kind of different motivations, or does it really depend on kind of the individual need of a certain point in time that they might need liquidity?
Yeah, so the overarching need is liquidity, stating the obvious. But then you always have supplemental objectives, so to speak, right? So like from the insurance company's perspective, a side benefit to sponsoring a CFO in addition to generating liquidity is reduced capital consumption, right? So they can reduce the dollar amount of private market exposure, and then they end up applying high risk-based capital charges, but then the final dollar amount can be lower. So that's a side benefit from an insurance investor's point of view. If a large-scale family office, for example, sponsor a CFO, yes, they get liquidity, but that also implies leverage, right? So they're putting on leverage on their private portfolio. And if the quality of the portfolio is good and the portfolio performs, then they will have earned levered exposure, levered returns on that portfolio, which then may improve their overall performance, if that makes sense. So there are there can be multiple objectives in addition to just the liquidity. One comment one of our family offices made actually, which I liked, they basically said they are almost in full control of deploying capital, but they have very little control over receiving capital. So the CFO program basically improves some of that dynamic so that they can be slightly in better control of cash inflow, so to speak.
Are some of these structures, getting even more complicated? Say from 2 or 3 years ago to today, and maybe 2 or 3 years in the future? Are we looking at even more complicated structures?
Yeah, like I think that's also a natural evolution of financial products, right? So the first couple of CFOs we did back in 2021 was pretty simple.
Mhm.
2 or 3 most rated tranches fully funded. We didn't have delayed draw features back in the day, for example, and then unrated equity. Over time, we started seeing delayed drawing, rated notes, delayed drawing equity. We started seeing pref equity transactions. I'm sure you heard about it.
Yep.
Some of that was publicly announced on Bloomberg and what have you. We started creating what we call a hybrid CFO, which basically combines seasoned portfolio of assets to seed the vehicle, the CFO vehicle, and then the vehicle making new commitments to new funds, which checks quite a number of boxes from a structuring and syndication perspective. We call them hybrid CFOs in the sense that it's like a hybrid between a GP CFO and an LP CFO. We did one interesting structure for 30-year maturity, basically. It was a fundraising tool for one of our GP clients, and the amount of money we raised basically is locked in semi-permanent capital that can be reinvested and redeployed into a number of their funds. So that was quite interesting. I think those are and then now we are combining closed-ended funds with open-ended funds in CFO formats. which improves the liquidity profile, because open-ended funds at least are redeemable up to certain gates and what have you. So yeah, we are trying different permutations and combinations to improve the performance of the vehicle in general, if that makes sense.
I mean, it is part of the reason someone would come to, an Evercore versus say bulge bracket investment bank is the flexibility and the kind of the one-stop nature of kind of where you guys play. It seems you've become a specialist in some of these areas.
That's exactly right. I think like this is something I keep telling it to our investors and clients. When I was at UBS, I started this business when I was at UBS, and UBS is a bulge bracket bank. We had an army of salespeople, both investment grade and high yield and what have you. But what ended up happening is pretty much I ended up talking to all of the investors during the syndication process. Unlike a regular way DCM business where you basically you do a teach-in and the sales team goes out and sells the securities, I ended up speaking most of the investors, which tells us that this is a specialist market. What the people who syndicate the transaction need to know a lot of details about what goes into the vehicle, why we did what we did, for example. We get a lot of questions around those. So I think it's more important to have dedicated team of specialists in the space than an army of salespeople to be successful in our product.
You mentioned the GP client, the LP client. How different is the GP experience through some of these versus the LP experience, and how different is the motivations for the GP versus the LP?
No, very good question. So LPs have been doing CFOs for much longer, I would say, right? You have Temasek outside of the US, which has issued about 8 CFOs. And you have Nassau and CUNA, now Thrivent joined them, insurance companies in the US, which have issued between the 3 of them, I think there are about 7 or 8 or so CFO deals, and it's been going on for some time. They've been doing it for longer than the GPs. GP CFOs really started picking up in 2019, 2020. So even though GPs are a little bit late joiners to the game, it became a lot more common across GPs to see CFO programs being set up. Like from our perspective, most of the large, well-established GPs with multi-strategy platforms and a strong track record are now setting up these CFO programs to supplement their fundraising efforts. But they will always have regular way LPs in their funds.
Yeah.
They will always raise funds in the traditional way, but most of the large GPs will set up these CFO vehicles, which provides the investors basically different entry points into their platform. Some investors will come into the senior, some investors will come through the mezzanine tranches, some investors will come through the levered equity tranches. Just expands the investor base of a GP, if that makes sense. And from our experience, if a GP has done one CFO, they will do follow-on CFOs. Basically, most of the GPs that we work with has done multiple CFOs in the last 5 or 6 years.
When one of the kind of hotter topics, especially in the private debt, private credit space, is insurance capital. And I'm curious, given the role you guys play, and all the structures that you help either LPs or GPs with, is there kind of a fear of too much complication, manufacturing assets, like we're not that far removed from the GFC? Where are maybe some of the risks that come with some of these structures? And is there increased risk, or is the multiple or diversity of entry points, does it help with risk?
A couple of ways to answer that. I would say if you roll back the clock and go back like 5 years ago, it's true that 90+% of our investors have been insurance companies, right? They are the big fixed income players. They have long duration asset, demand, and it's patient capital from that perspective, right?
Yeah.
Insurance companies buy and hold and match to their life. It's patient capital. When you look at the private markets require patient capital, right? So from that perspective, it's a good match. And because the insurance investors don't require liquidity very frequently, they are more of a buy and hold investors. They like that excess premium they get out of illiquid products like CFOs, right? So from that perspective, it was a good match. And they're sophisticated. They've always been at the front lines of new product developments and what have you. It's just natural that we develop this product with mostly insurance investors. But over time, when the product grows, it's just healthy for us to build a broader investor base. That's why I started going to Canada, talking to pension plan investors, talk to like Canadian insurance companies, which have a lot of US dollar, long duration US dollar asset demand. Visited Asian investors, like Korean investors are active in this space. Taiwanese investors showed interest. Japan is always slow to move, but if and when they like a product, they can be very, very meaningful. I started going to Middle East to talk to them about this new product. So the point I'm trying to make is, yes, we did start with mostly insurance company investors, but if you look at our broader investor universe, it's expanded. The bigger growth in our investor base is outside of the insurance space, and which I think
Interesting.
is healthy.
Yeah. When going to, a follow up on that on some of the newer markets, whether it be Asia or the Middle East, like what's kind of the best way to approach them with a new product? When trying to explain this, because I presume, the CFO product, while you mentioned, a bunch that were done by Tomasic, a bunch done by, some insurance companies, the GPs, it's still fairly new, but like a place like the Middle East or Asia, how customized are they to this
Yeah.
product? And what does it look like when you say, wait, a CFO, and they're like, huh?
Yeah, no, you you have to be very patient. Let me put it that way. So I think I visited Asian investors 4 times already in the last 2 years, and we haven't actively sold. We did not actively sell to Asian investors yet. Most of my trips were around we labeled them as non-deal roadshows, basically, where we talked about our platform, the new products, the volume, the precedents, and what have you. It was more educational and awareness type.
Mm-hmm.
Then we started getting some inbounds from those investors. Like they are very slow, unfortunately, from a due diligence perspective. By the time they complete, we are done and we are on the next transaction. But eventually, they're going to get there. Similar story with Middle East. There are a lot of LPs who are familiar with most of the Western GPs out there. We are just adding a new product layer. And when you explain the CFO product, like this is kind of like a CLO, but the underlying assets are private assets, most people
Yeah.
get it right away. But it's you have to be patient in terms of how quickly they can come up to speed and start participating.
So in terms of, the, you know, volatile period that we've seen start the year, it's kind of seemingly has settled down though. You never know with the new administration what announcement can be coming next. I mean, what kind of impact does that have on the CFO market, if any at all, or is the long duration patient capital kind of move past some of that, day-to-day volatility or quarterly volatility because of the long duration of the assets?
Yeah. No, that's a fair question. It's also a little tough question. I mean, we definitely get impacted by the short-term market fluctuations, right? This both rates and spreads, especially early on after the what did I call it? The Liberation Day,
Yeah.
uh, you know, ballooned quite a bit, which is when we slowed down our origination because the pricing would have been a little bit too expensive. But none of our investors went on a risk-off mode, so to speak. So right now, and we see we know what's happening in the Middle East. That's obviously not helpful. But again, it's still our investors are still active. They're still looking at our transactions, and it's a matter of pricing, like
Yeah.
making sure they're compensated for the potential risk that they're taking on. We haven't seen a risk-off mode from our investors yet.
How long does it usually take to complete a deal
Oh,
from inception
t-
to
yeah,
when you finish the transaction? And then second, kind of a follow on to that is, what does that look like today versus like 2020,
yeah,
2021? Like how much has it evolved in terms of length and kind of time
yeah.
that it takes to complete one of these?
It's definitely getting better. We have now investors who are familiar with the product, familiar with our style. They have seen our sales memo. We produce a sales memo which is loved by the investors in the same exact format. So when they get project X and project Y, they look similar. They can easily compare and contrast. And like that, all of that education is done, at least in the US investors. But it is still a lengthy execution, especially for a first-time issuer. We recommend our clients to budget anywhere from 3 to 5 months from
Hmm.
start to finish. A good chunk of that amount time is spent on optimizing the portfolio with the types of assets and what have you. And then obviously the ratings process is important. The rating agencies are fairly busy. The legal documentation, yes, we have a lot of precedents, but still there are some changes and unique features that needs to be incorporated. And then if we are marketing equity of the CFO, that we, it tends to last a little bit longer because that's the more labor-intensive part of the deal. Yeah, so anywhere from 3 to 5 months is what we recommend our clients to budget for.
And what is the ultimately like when you have it, set up? If you include equity as well, what do the different investor pools look
Mm,
like
yeah,
from top all the way down to the bottom?
no, that's a good question. So Class A's is almost always insurance companies and pension plans.
Yeah.
Fixed income side of their portfolio managers, and their demand is almost limitless on Class A's. That's investment grade. Class
Yeah.
Bs are also investment grade. They're investment grade, but they're not top of the stack. So they earn about 200 basis points premium over a Class A, which is attractive, and it's a very thin slice, right? So our Class Bs are almost always oversubscribed, and usually you would see, the asset managers, hedge funds, structured credit investors who are also active in CMBS and CLO market,
Yeah.
for example. Class Cs are sub-IG transactions. They are at the upper end of the sub-IG category, like double B flat or double B plus. That's fairly attractive. Right now, they are paying about 800 basis points over US Treasuries, like 12% yield is a decent yield. And there's at least 25% cushion, equity subordination below the Class Cs. So usually participated by, hedge funds, again, structured credit investors, preferred lenders like the Class Cs. And equity has a number of buckets. The managers always retain equity as alignment of interest.
Hmm.
Some of their strategic LPs, especially if they like the manager and they're comfortable with taking on leverage, they can come in through the CFO equity instead of into the fund directly. But family offices like the CFO equity, especially if a family office like the GP, and if they're comfortable with taking on leverage on their portfolio for any reason, the leverage we have in the CFO vehicle is a lot more patient, and sticky and cheaper than the leverage they can get themselves from their own bank or other lenders.
How much would you say is related to, well, a lot of it's obviously related to the mix of the assets, but you mentioned a couple of times if they're comfortable with the GP. How important is that to some of these transactions?
Oh, very, very important. Like that's I would say number one criteria. Right. That's why I said what I said in terms of like the GPs with well-established, good, long track
Mm-hmm.
record and a multi-strategy platform are the ones who are issuing these vehicles. Because as an investor, you are coming into a vehicle which is making new commitments to funds that are still deploying.
Yeah.
And those funds have only very little on the ground most of the time. So yes, you can look through and do some due diligence on the deployed investments, but you are really relying on the manager's track record. Right. So from that perspective, the GP quality is number one criteria.
So we have just a few minutes left here. And you've answered all the tough questions. So now, now we're on to more of the fun questions as we wrap up here in the next few minutes. So, do you have a favorite sports team or favorite hobby?
Hobby. I started losing my hobbies a long time ago, as you can imagine. The only hobby I have left is cycling, which is also taking a hit this year, given how busy we are. And I bought a guitar as a Christmas gift to myself, and I started playing again after 15 years or so.
All right. Well, there you go. Two hobbies there. Well, I guess maybe you might have a different answer to this, but I guess we'll see. Which is one surprising thing about yourself.
Uh, uh, I don't know how surprising it is, but when I tell people that I spent 4 years living in Japan, in Tokyo, people are surprised a little. Um, it was quite some time ago. My timing was not ideal. I was there in the middle of financial crisis, but I went there right before and I came back after. But that would be one, and I'm sure everybody is recognizing the accent. I am not born and raised in the U.S.
Well, yeah, it doesn't surprise me that you've certainly traveled there. I mean, that must have been quite the tutorial on a financial crisis in
Yeah,
Japan at
yeah.
that time.
Well, I was, and what's even funnier, but not as funny, but I was working for Bear Stearns at the time. So,
Um, one book that you'd recommend reading.
oh, The 48 Laws of Power by Robert Greene. Amazing book. I read it once. I'm reading it again, and every time I have some free time, I just randomly open a couple of pages and read it. That's an amazing book.
Most exciting part of your job.
That's a tough one. Um, what I love about my job is the fact that we don't do the same thing over and over. Every mandate, every deal has something unique, some new challenge, or some improvement that we come up with, which is what makes it interesting um, for us. And like being at the forefront of a new product that I have the luxury of being a first mover back in the day is also quite nice. There's nothing we haven't thought about or done before. Nothing is new to us in this space. And then when we try something new, we have a very good idea about whether or not it's going to like how it's going to play out. So being in that position is pretty exciting actually,
It's
as
got to be
opposed to
pretty.
like
I was gonna say it's got to be pretty gratifying to see kind of where CFOs have kind of taken off, given that you were kind of in on the ground floor.
yeah, no, absolutely, absolutely. That's a great feeling, absolutely.
And then final question, one prediction for the next 12 months.
Oh, that's a tough one. Uh, well. Okay, I'll give you a non-answer. We will be a lot more busier in the next 12 months than we are now.
I'll take it. Ahmet, thank you as always for your time. It's been great to chat with you and see you again, and for the continued support. You've been a very helpful voice for us on the Fund Finance event. So thank you very much. Good to see you again, and obviously continued success to you and the team.
Likewise. Thanks, Todd. Thanks for having me.
Of course. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.